What we're presenting today is a mock presentation of a business plan. In this presentation, I represent a company called eRock Solutions based in Chicago. We present financial plans to corporations in order that they can enrich themselves. We have over 100 years experience in both financial planning and insurance. Today's plan is called Bank Financed Life Insurance. Under this plan, we bring together an insurance company, a bank, your corporation, and your employees. All the banks we deal with are nationally known, and all the insurance companies are rated A and A+. Under this plan, as the employer, you will allow us to come in and insure some or all of your employees. And each employee is going to be given the right to participate in the program.
Who pays the insurance premium?
eRock has relationships with banks such as ours that will pay all the premiums on the employee's life insurance. So there's no responsibility to pay the premium by either the employer or the employee.
How do we benefit from this plan?
At the time of death, the life insurance payment would be divided between an employer-owned trust, the employee's family, and the bank for repayment of their loan.
How much money does the employer get and how much money does the employee's family get?
We pay most of the money to the employer. The employees usually receive around 10 or 20%. That's based on a prearranged agreement between you and the employer. It's whatever amount you two would agree upon.
What happens if an employee leaves or gets fired?
Since the trust is the sole owner and beneficiary of the policy, the trust and policy remain in place. The insurance policy stays in effect. It is not discontinued.
What happens if the employer goes broke or just decides to close her business?
The trust and policy remain fully funded and in effect. Nothing changes. You will still receive your money.
Do we pay taxes on the money that goes into the employer's trust?
If it's a nonprofit group, such as a hospital or a university or a governmental agency, all the money paid into the trust is tax-free. Any nonprofit is tax-free. If it's a for-profit corporation, anyone salaried at $100,000 a year or more, it's tax-free. Plus 35% of all the other top salaried employees, that's all tax-free.
How can I use the money?
You can use the money any way you want. It's all your money.
Because the cash values of the policies are building in the trust, you can use these funds to pay for retirement benefits, health benefits, golden handcuffs and golden parachutes, unfunded post-retiree liabilities, and estate planning. The funds can be used in any way the employer wants, including endowments.
Is the employee benefit tax-free?
No, the money paid to the employees is taxed because it is considered an employee benefit and not insurance.
Why would an employee agree to do this?
Because all the money you get is still free money on top of whatever money you would have in life. So if you have other life insurance policies, it doesn't matter. You're going to get this money also. Leave the company, you're going to get this money also. You can use it for anything you want. Also, what benefits the company, if you stay at the company, is going to benefit you because they can use it for golden parachutes, golden handcuffs, retirement endowment programs. Whatever they use it for that benefits the company is going to benefit the employees.
Why would a bank lend me all this money for these insurance policies?
Because it's a secured loan. We look at it this way. If we lend money on a house, we run the risk of the borrower defaulting. But with life insurance, the actuary tables tell us everyone's going to die, so we're guaranteed of being paid.
How come I've never heard of this before?
Because this program is very new and only a few others in the country are doing this. But we brought the bank and the insurance carrier together so that we can offer it to you and many other people in the country.
I remember now. I heard something about employers buying life insurance on their employees in Michael Moore's movie on capitalism, but he said it was illegal.
What he actually said was that in the past, corporations such as Walmart have been signing up their employees for life insurance without the employees' knowledge and consent. So this was considered unsavory that Congress passed a law in 2006 called the Pension Reform Act, Section 101J, which said you may not sign up your employees without their knowledge and consent. But the fact that this was mentioned in the movie shows the power of what we are offering. In the past, those corporations that were signing up their employees without the employees' knowledge, they were paying the full premium on it. We're bringing a bank into play, and the bank is going to pay the premium for you. All you're going to have to pay is 5% of the premium as interest, which repays the bank loan for the first 3 or maybe 4 years. Now, the reason it stays at 3 or 4 years is because it's going to build a tremendous amount of cash value, and that cash value will allow it to finance itself after that period of time.
So, if the bank is financing $1 million a year in premium, the employer only has to pay $50,000 in interest the first year, $100,000 in interest the second, because now they are carrying 2 years, and $150,000 the third year, for a total of $300,000 if it's a 3-year payment. This would probably buy about $30 million in death benefits.
And there are other means of financing this deal, which we can discuss at future meetings.
This seems too good to be true.
We're going to prove to you that it's not too good to be true. We're going to bring banks and insurance companies to the table. Like I said before, the banks are going to give you financing contracts, and the insurance company is going to give you quotes. And through those quotes and financing contracts, you're going to see that this deal is going to work perfectly for you.
Is there a limit to the size of deals you can make?
No. As long as you have a verifiable net worth of $5 million or more, we can finance as much as the insurance company is willing to write.
For employees, we can insure between 5 and 30 times their annual salary.
Let's go over the basics again so I make sure I understand this.
Okay, the way the system works is EROC is going to bring a bank and an insurance company together with your company. The insurance company is going to write insurance, life insurance, on all or some of your employees. The bank is going to finance the deal by paying the premium on those insurance policies. Your responsibility is going to pay 5% interest on that financing for the first 3 or 4 years. And the reason you're only paying for 3 or 4 years is because the policies build cash value. And after they build cash value, they'll finance themselves to repay the bank. At the time of death of an employee, the death benefit goes into a trust that you control. You take some of the money out of that trust to repay the bank for its loan, above and beyond the interest. Take some of the money and repay the family of the employee in order to repay their death benefit. The rest of the money that's in the trust is fully yours, it's tax-free, and use it for anything you want. And a great benefit of this is not that if it's $200 million in death benefits, in time, it's going to build enough cash value. That may double, triple in time. It could be worth $500 or $600 million.
And again, you guarantee that all the insurance companies are A or A+ rated, and all the banks are large, nationally known.
Yes, and we can bring the banks and the insurance companies to meet with you anytime you want in order to prove everything.
Okay, then let's set up a meeting to get the process started as soon as possible.